Hi guys and welcome. On this video, we are going to discuss about subsidized and unsubsidized loans. How do they work? What are the differences? And where each of them shines? If you're planning on going to college, you should know that most students need some kind of loan to help them. Whether it's a federal loan or a private one, it's generally going to be a necessity, even if you don't want it. Those federal loans generally come in the form of direct subsidized loans, or direct unsubsidized loans. The subsidized version is the kind that doesn't add interest while you're in school, which is definitely a bonus. Now, if you're looking at getting either of these types of loans, it's important that you pay attention to the differences. That way, you can know how the loan is really going to work, how you're going to pay it, what you're going to end up paying, and more. So what are subsidized student loans? A direct subsidized loan has an interest rate that's set by the government, which means you don't need to have any specific credit score, and you also don't need to worry about the rate changing at all. On the other hand, you're only going to be approved for a set amount of money. That's because you have to be eligible based on financial need. Your FAFSA form is going to be the best way to find out what you qualify for here. The federal government will look at your FAFSA and will then decide just how much financial need you have. What's really great about this type of loan, however, is that your interest while you're in school and during the deferment period is actually paid off by the government. As long as you are enrolled half-time and for 6 months after you graduate, you won't have to pay any interest at all, and when you get to your loan after that 6 months, it's going to be the exact same amount that you borrowed in the first place. Once that deferment period ends, though, you're going to be responsible. One of the downsides here is that you're going to only be eligible during your undergraduate years. Still, you can get some great benefits, even if you have to defer your loans later on. Subsidized loans have a couple of great benefits. The government pays the interest. This is definitely the biggest benefit and the best way that you're going to save money on your loan. You're not going to have to pay the interest that accrues during the time that you're in school or for the first 6 months after you graduate or stop attending. This could actually save you thousands of dollars depending on the amount of money you get. Lowered interest. This type of loan is going to have a low interest rate, and that rate can't go up during the life of the loan. Plus, it doesn't matter what your current credit score is or what your history is like with other types of loans. You'll still get the same rate, which in 2019 is 5.05%. Protection during hardship. If you fall on some hard times and you need to defer your loan, you're going to have the opportunity to do so with this type of loan. You'll also have interest paid for you during certain periods, including during eligible deferments and forbearance. Plus, some repayment plans will pay the interest for you as well, which means you can get a whole lot of assistance. On the other hand, you should always consider the drawbacks. Getting approved. In order to get these loans, you have to be enrolled at least half-time, and you need to be going to a school that participates in the program. You're also going to need to be pursuing some type of degree or certificate, and you need to be working toward an undergraduate program, not a graduate degree. Limits on what's available. There's a specific amount of money that you can be eligible for in your lifetime, which means that you can only get that amount. The amount also varies based on what year you're in for your schooling. Once you hit the limit, you're not going to be able to take out any more money. Fees. You may have to pay an origination fee when the loan is taken out, and that's not going to be deferred. Now, let's discuss about unsubsidized student loans. Unsubsidized loans are going to charge you interest from day one, even though you don't actually have to start making payments that early. What happens is you're going to complete your FAFSA just like with the subsidized loans, and then you're going to be declared eligible. You don't need to demonstrate financial need here, though. Instead, you're probably going to be offered enough unsubsidized loans to pay for the rest of your term or year. What happens here is that you're going to be responsible for the interest, but it won't be charged to you until you stop attending school, at least half-time. At the time that you graduate or stop attending school, the amount of the interest during that time is added to the total that you borrowed, and you start making payments. You do get a 6-month deferment here as well, but there's still going to be interest adding on. What's great about this one, however, is that you can generally get as much money as you need because there's no requirement for you to prove financial hardship. You can also get this type of loan whether you're going for your graduate or undergraduate degree. Unsubsidized loans have a couple of great benefits. High limits. You can generally get as much money as you're going to need with this type of loan. For an undergraduate student, the limit is approximately $31,000, and for a graduate student, it's generally $20,500 per year, or $138,500 in total. But that's definitely going to get you further than what you'll probably qualify for in subsidized loans. Easy eligibility. You don't have to qualify for this loan with specific financial need, which is going to make it easier to get the money. You will still have to file the FAFSA form, however, and your eligibility will be determined from there. Interest charges. As we mentioned, the interest won't be charged to you until you stop attending school, at least half-time. Also, here you should always consider the drawbacks. Paying interest. You're going to be responsible for the interest on your loan from the moment that you take it out. There's no grace period here. That means you could end up spending a pretty large amount of money, and when you start making those payments, your total will be more than what you borrowed because of that interest. No legal protection. If you default on your loan, there's no protection here. The government can actually garnish your wages, and they don't even need to get a court judgment in order to do it. Plus, they can take your tax refund from your income tax. Fees. You may have to pay an origination fee on this type of loan as well as a subsidized one. On the bottom line, when you're looking at the different types of loans, the best thing you can do is definitely to get a loan that will help you with your schooling. Whether you have to pay interest from the start or later, however, is definitely going to make a difference in your total payments. If you're going for an undergraduate degree, you're going to get the same interest rate with either option, which means you're going to want to go with a subsidized loan if at all possible. You won't have to pay as much in interest with this option. On the other hand, an unsubsidized loan is generally going to give you some better options, but it's going to depend on a number of different things. No matter which of these loans you're looking to apply for, you need to fill out the FAFSA form. From there, you'll be given information about what type of financial aid you actually qualify for, including aid that's provided directly by the school. If you don't have financial need, or if you're working toward a graduate degree, you're not going to have the option for subsidized loans, and that means you may need to take a look at unsubsidized loans, plus loans, or private loans. If you can only get a plus loan or an unsubsidized loan, you may find that the interest rates are better with a private loan. If you have a cosigner that will help you out, this is even more likely. After all, plus loans are usually set at 7.6% interest, and private loans can be quite a bit lower. This type of loan comes directly from your financial institution, or any financial institution, and it has nothing to do with the government. You usually have to have credit history and at least halfway decent credit in order to get approved, or you need to have a cosigner. On the other hand, you generally won't have a limit to how much you can borrow, and you may have a high or low interest rate. If you can't qualify for federal loans at all, this might be your only option. But if you have the ability to get federal loans, even unsubsidized ones, this is generally going to be the last thing you want to do. If you end up with problems paying back a private loan, it could end up on your credit report, and it could make things difficult for you for a whole lot longer. Not to mention it can cause some problems for your cosigner if you end up defaulting on the loan. Make sure you're paying attention to the options in your financial aid package and that you're getting the best possible loans. That's it for now. On our website, you can find more posts, as well as calculators and other financial tools. Subsidized or unsubsidized? Which one of them works better for you? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel to get the best financial videos for free.